Hello, everyone. Thank you for coming to this second episode of our AMA series called Making the Turn. Um, Today, we're going to continue along. We'll get into a lot today, and then we'll, of course, answer all the questions that were pre-submitted and any questions that you want to submit. I would like to invite you, if you do have questions as we're talking, or if you have a question that you did not pre-submit because you didn't know you needed to pre-submit it, that's cool. You can just drop it into the question and answer panel, not into the chat panel, so that JC here can find it and make sure it gets answered and filed away. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. So here's where we're at right now. So episode 1, we're going through a model prop trader who is, his name is Earl E. Bird. And so we're taking him from trainee to senior trader, and we're creating this as part of a series as opposed to an AMA, a typical AMA where we just answer questions. We're going to do that anyway. Episode 1, we took Earl, who came in as a potential new hire on a 2-week probation trial into our prop shop, and we talked about what his experience was. You can go and watch that. I think there are a lot of nuggets in that. If you want to listen to it on YouTube, you can find it at go2ct.pro/MTTAMA1, MTT Making the Turn AMA1. That's the link, and you have it in your chat box. You might want to pull it up and kind of bookmark it or store it for a minute. Today, we're going to talk about, in episode 2, we're going to talk about Earl moving from new hire potential to actually making the cut. He's now a trainee trader. What must we do to make the turn happen? So we'll talk about that today. The next episode will be Earl getting to be a junior trader. He made the cut. He's actually a trader now. What does he need to do and how does he develop as a trader? That episode will be on April 23rd, 2025. So you might want to pencil that in. And then episode 4 will be a month later sometime. We haven't set a time yet. What Earl's going through as a senior trader. How do we manage consistency and growth? So let's go back and talk about Earl a minute. So Earl, just to follow on to the journey, he's passed his two-week probation with a bunch of people that were inductees into the prop shop. He didn't get caught. He was able to join this real prop shop. We're not talking about funding programs. We're talking about full prop, meaning a salary and all that stuff. Earl made some mistakes, but then he shaped up and started taking his trial prop position seriously. After 10 days, Earl was reviewed, and his head trader decides to move forward with him as a trainee trader. And that brings us to today. So now, Earl, as a trainee trader, we get to follow him on this phase of his journey for today. Earl has to spend a lot of time. So now he's actually in. Now he's spending a lot of time putting together his proper trading plan that we know he can follow so that we know that he can follow the simple process provided to him during his new hire phase. Now he has to put together his personal plan. Every trader needs their own personal plan. There is no folder that we can give a trader and say, do this. It has to fit how you see or what you believe about the market. So Earl spends time learning how the market works, gets deep into the auction mechanics, works through organizing data and how his edge will work. He finalizes the entire process, including proposed risk sizing, specific setups he will be looking for or expecting, execution process, market bias assessment, trade management plan, record keeping plan, etc. All the key components to a trading plan, which every one of you has, right? Um, he proposes this process that he's going to follow his trading plan to his head trader for approval. So what does that look like? He spends 3 to 4 weeks of his full time. So he's a full-time employee, right? For his full-time gathering the pieces to figure out his edge. He puts it all together into a plan and tests it over the next 4 weeks. So essentially, he spent 8 weeks from the time he was first inducted as a trainee trader, putting this together. Once he's clear that he can pull the trigger on it, he prepares a proposal and gets it reviewed by the prop firm. Earl's plan is reviewed, some changes requested, and it gets pushed through. He now sees the light at the end of the tunnel, but things get scary and real for him, right? Now he's going from like, it's all academic, like studying things, testing things, to now, you know, he's going to have to go trade it. So the last step, of course, Earl meets with the risk team to explain his plan and how it's supposed to work. The risk team is responsible for cutting him off if he falls off the plan's requirements. So the risk team needs to understand what he's supposed to trade, when he's supposed to trade. In general, they'll have an idea, a profile of what he's going to do, because without that, they can't effectively manage him. The risk team rubber stamps the plan. Their job is not to assess whether or not the plan is good. Their job is to make sure that all the risk controls are in place and that those risk controls are programmed into the back end. You know, daily loss limits, size, max size limits, which contracts, like in prop, you don't get what you get in with a brokerage account. A brokerage account, you could trade whatever as long as you have the margin. In prop, the leverage is really high, right? It's 1,000, 1,600 to 1, 2,000 to 1. And so the way prop shops manage that is they permission you for particular products and they permission you for quantities you can trade within those particular products. So it's a little bit different. Earl finally gets his credentials, his live trading credentials, and it is game time for him next Monday, and he's starting to stress about it, right? He's doing the right thing. He's going to spend the rest of the week this week focusing on studying performance psychology, making sure that his mind's in the right place. This is the last step before he shows up on Monday and becomes a trader, trading a live account, right? The money's going to be on the line. So next Monday shows up, day one of trading. All's good. He's following his process, taking notes on the markets. Things are playing out the way his scenario is expected. He manages to pull the trigger on his first trade. Lots is going on in his head about this trade. He can see why it shouldn't work. He knows he can't touch the mouse, however, but he can make just as many arguments for why the trade might work as there are for why it wouldn't. And then finally, the trade is actually getting some MFE, some maximum favorable excursion, meaning it's moving in his favor, and things are looking great. Target hit, yay. Earl's first trade is a winner, which is really a terrible thing for a new trader to have a winning trade the first trade. Anyway, another setup shows up and he takes it. So much confidence. He has mastered this. Easy peasy, no problems, right? Okay, weird. As the trade is sitting there working, he's long, size is hitting the tape against him after the trade was going for him. So all of a sudden the trade comes right back to where he entered. He waits. Suddenly there's a flood of selling against his long, which is within the plan. The trade almost takes out his stop and goes back to break even. It then turns down and flirts with his stop a bit. He decides this is a momentary thing and pulls his stop down to give it more room. Trade's got to work, right? Seems to be working. Back to break even. The market goes back to break even. He's still holding on. Then suddenly the tape gets smacked even harder with even more size. Clearly, there's some news going around it, and it's coming in waves. The movement's coming in waves. It's fairly typical. Insiders get it first. They trade it. Then the market kind of recovers, and then the news hits wider channels, and the market sweeps down as the news is confirmed, and he's stopped for more than his initial risk parameters dictated. This sucks. Tariff news, oh well. There's a ton of movement, most of it selling. He can't miss it. It's outside of the scenarios he planned for the day because it's a news-based day. It's kind of funny. Today is one of those days. Actually, this is exactly Earl's type of day right here for this scenario. There's a ton of movement. Most of it's selling. He can't miss it, so he attempts a scalp short out of plan, which means he has no stop, no target, no real plan. It looks good though, and hey, the trend has changed, and I have to change how I trade with it. The tariff news is refuted by someone in the administration, and the market rallies back to where it was, where he got stopped. It rips up harder than it sold off. Earl has no stop because this wasn't a planned trade. Earl has hit his daily loss limit, gets pushed out by the risk team. He expects a visit from the risk manager. That's his first day. So we went from a euphoric first trade to daily loss limit. This is actually relatively typical in prop. Tuesday comes along, second day, he gets a talking to. He knows he has to stick with his plan. That's the job. He sees things playing out. He feels kind of beat up after yesterday. He isn't really trusting what he sees, so he sits out most of the setups. Just having a hard time pulling the trigger after what happened yesterday. His plan would have put him in good trades, but he just can't take another loss like that. Unfortunately, Earl doesn't trust himself today after yesterday and basically doesn't trade at all. That's day two. Day three, by the way, you're not required to trade in prop, right? You don't have to trade. It's not like a funded account where you have to trade a certain number of days or whatever. Days 3 and 4, he's starting to see things play out as expected. He's gaining his confidence back. He's just forgetting the pain, or maybe he's just forgetting the pain of that one terrible scalp trade. He's following his plan. These are break-even days, and he's happy. Days 5 through 10. So this is the second week now. The markets are erratic due to news events about tariffs, war, jobs, whatever. The market's not what he studied. 3 stop outs in a row following the plan. Daily loss limit on the day, and he's out. The saving grace is that he stuck to the plan and didn't do anything wrong. He feels like maybe this isn't so easy. Maybe it will never work. Days 11 to 20. So we're a month in. He's chugging along, but overall, he's breaking even minus costs, and it is wearing him out. He's doing what he's supposed to do daily. The guardrails he designed are keeping him in the game. He has to put off buying that Lambo for a little bit. His dreams of driving that fast car are just fast fading. Days 21 through 30. So now he's a month and a half in. Basically, markets are back to normal. He's seeing his edge play out. Very consistent performance and results. Green day after green day. Small, but it is accumulating. Things look great. He has made enough in his account to add one more contract to trade. Great news. He gets permission for the one additional contract. He's going to chill into the weekend and start Monday with his new size. Monday comes along. That's day 31 through day 35. The first day he's back with his new size. He ups it as expected. Things are shaping up well. Volatility kicks back in. And now he recognizes it better. Unfortunately, his stop outs are too tight for these rotations. He has not adapted to the higher volatility, and he gets 3 stop outs in a row with the bigger size. He has given back all of his gains as a result of some forced trades. He's struggling to not look at his P&L, but it's really difficult. Things are frustrating, and it just seems like he is churning and not getting anywhere. Days 36 to 60, which is now 3 months in. He keeps showing up, following the plan. Things are moving along, some good and some bad. He's hanging in there with a break-even overall performance. In the trainee trader world, this is an outstanding outcome after 3 months. So after 60 trading days, 3 months of live trading, the fact that he's churning and he's at about break even minus plus costs, the more experience, this means he's gaining a lot of experience at the lowest cost possible. He's actually doing very well. The goal is to get to the point where the trades kind of happen, the setups, the more you trade, the more the setups kind of become intuitive. The goal is to get to the point where they just happen. Once that is firmly in place, we become a junior trader, which is episode 3. That's the journey for today. So from here, what do you guys think of that short story. This is a quite a typical scenario for someone kind of doing this. Now imagine doing this by yourself remotely as an online trader with your own account or some funded trader account, but you're remote, no real risk management, part-time because you have a job, many distractions, and no one there to really guide you. It becomes a lot harder. So you could see the first 3 months for this person have been kind of grueling in addition to the 2 weeks to qualify. And this is really, really typical. And the biggest thing that being in a prop firm or in a group does for you is it provides constant frame of reference to find out to measure where you are versus everybody else. Okay. Let us know if you have questions about that scenario. We'll continue on next episode with Earl kind of working his way to becoming a junior trader, which means that now he is not being directly monitored and kind of the guardrails fall off a little bit. Okay, quick announcement while we're here. The accelerator program cohort 4 is in play. The registrations for that have started. We will start the next cohort on April 18th. A reminder that a cohort consists of 4 weeks of study, coaching sessions at the end of each week. And then the last week, the fifth week, John and I go live and we walk through the whole enchilada from prep, doing a bit of a trader bite, going over scenarios, what's expected, going over the setups, and then waiting for the market to open and then just taking the trades as they show up. In other words, we don't go chasing trades. That's the week of the live week, which is the fifth week, which will be May 19th or so. That's the week where we expect you to be there live and to kind of put your life on hold to get the most out of it. We'll do the execution lab in the morning, live trading in the morning, and in the afternoon we'll do a workshop a day for 5 workshops, and we'll wrap it up that week. So to learn more and sign up, point your browser to go to ct.pro/accelerator 2025. You have that link in your chat box. In addition to that, we're releasing the accelerator program in the form of a course called the Accelerator Course. This is a self-study. Look for an email from us if you're already on our list. Episode 3 will be again on the 23rd. Be sure to save the date, and we'll just come back and continue the discussion. If you have a question, don't forget to put it in the questions box and we'll try to address it. JC will interrupt us and plop your question in. But a lot of questions have already been pre-submitted. I'm going to invite John to pop in here and start hitting these. This first question: after a series of account blow-ups and following the advice of another senior trader in the Convergent room, I've imposed a self-exile and stepped away from trading for the past 4 years. Wow. Looking back, my biggest challenges were breaking rules, having too much bias, revenge trades, letting losers run, cutting winners short. However, after this time away, pain of sitting out, suffering, I believe I've developed the discipline needed to approach trading in a more structured manner. It's been 4 years since I've been completely disconnected from the markets, but I feel ready to make a fresh start and give it another try. Coming back with a clean slate, an open mind, and a no preconceived biases about the market. I wanted to reach out to get your advice on how to re-engage. I'd appreciate any guidance or primers you would recommend to help me restart effectively. Your insights have always been invaluable, and I'd be grateful for any suggestions you might have. This is from Babu. What do you think, John? What would you recommend here?
Well, he mentions that he believes he's developed the discipline, but he doesn't mention if he's done anything to work on that discipline. But regardless, the big thing that I would say to Babu is don't assume that the problems you had before are gone. They're not going to be gone. It's like if you were a pitcher and you hurt your shoulder and then you just didn't pitch for like 2 years and you came back to pitch again, unless you got that injury treated, it would still be there, you know? And it's very similar here. Now, you have to be aware as well, though, discipline is something that you will have more discipline when you start because you've had time away, so you're more emotionally detached, but all the same problems will come up. So the advantage you have now, I believe, is should be awareness. That needs to be your advantage. You know what your past problems are, so I would recommend that you start back very slow and expect to encounter those same problems, and then have a plan for what you're going to do at the initial outset of those problems, because the old ones are going to come back. Your advantage now is you have the awareness of them. Attack them as soon as they show up. Start slow so they don't all, you have three, you have 3 good days, everything's easy. Then one day, it goes crazy, you blow up. Be aware that that's something that could happen. Have a plan in place because the old problems will come back. Your advantage is now you know how to face them, or you have a better shot at them.
Very cool. Thanks for that, John. Um, how many structured trades do you have, and do you mind sharing their names? Do you only take structured trades? How many trades do you take in a day, and what percentage of them are there in the first 2 hours and final hour? That's question number one. Question two, I regularly review my trades and trade management, but what is the most effective way to do this? I thought about recording it. This is from Xavier. What do you think, John?
Let me answer the review question first because I think that's probably the one that could help the most people, and I can get in the cleanest answer. So how do you review your trades? First, if you can record your screen, that's fantastic because you have a perfect record of what happened. So if you're able to do that, I recommend it. I generally do it. In terms of what you want to be reviewing is whatever block of time your execution hours are, you want to be comparing what you did in real time versus what the optimum trader would have done in that span of time. And you're going to have the advantage to do that in hindsight because you can go through and say, okay, according to your system, what would you have done in this place? What did you actually do? And then you compare those two things. And what you're going to find if you do this correctly, anytime that there's a divergence between what your plan says you should do and what you know that you should do in hindsight, but you did something different, there's going to be some mindset issue there that you can then identify and work to overcome. A setup appears, you don't take it. Why? What were you feeling at that time? Were you afraid? Had you just taken a loser? Or something happens with some news and you FOMO in. Why? Why did you do that? You're gonna find the mindset issues that you need to attack when you compare what you should have done versus what you did do with the benefit of hindsight. This is only if you have an actual system, though. I should add that. If you don't have a system, then getting a system comes before reviewing.
Q1.
Oh, Q1, yeah, I forgot. How many structured trades do you have? So for me, structured trades are more about the reason behind them. Meaning, if I have a bias on a daily or weekly time frame, and I'm trading that bias, based on areas that I think that trend is going to continue, then that's going to be more structured. An example of something like that in the day time frame would be the first pullback to day generated prices after the IB break when I have a plan and a bias and a target in that direction. That's probably that's a structured trade based on the day time frame. It's probably my best trade. I think it's one of the best edges available to day traders in the market that look to trade the auction intraday. Do I only take structured trades? No, I'll take scalps at times. And I would define a scalp as some type of an order flow, order based push in the market that is counter the daily trend or something like that. That's what I mean by a scalp. Like for example, I just described waiting for the pullback to day generated prices after an IB break. Maybe scalping the retracement to that could be a scalp. It's not something I base my day around at all. It's something I take when they're available, when they're low hanging fruit. How many trades do you take in a day, and what percentage of them are in the first 2 hours of the final hour? I don't always trade the final hour. If I do, it'll be one or two trades, generally specific ones. About 60% of my trades are generally going to be between the cash open 9:30 EST and the euro close. Roughly about 60% of them come then. Is that I think I got them all there. Other trades
Yeah.
come pre-open. I trade pre-open a lot as well.
Yeah, from my side, structured setups. There are how many? There are three, four structured setups. Um, we go over some of them in the accelerator program. We go over the structured trade, John's structured trade as well during the accelerator program. Um, how many trades a day? I would in the first 2 hours and the final hour. Um, honestly, like the setups pretty much if there's something to do, the setups are generally occurring either just before the open or in the first 2 hours. I honestly am not around. Given what I'm doing now, I'm just not around. Like I was just telling these guys, wow, the market sold off. Like I had no idea. I'm just not. I'm not involved in the final hour. Okay, anymore. I used to sit and trade the whole day, and that's not possible anymore. Victor, I noticed that even proper psychological planning, like journaling and even trying to hold yourself accountable, is itself a process. So your approach is a process, and so is the mental side. Wouldn't you say that mental rehearsal and hypnotherapy for trading success and emotional control and whatever other issues hindering the trader's progress is the most important thing once a trader has an edge? Continues to say the idea of rewiring the mind for trading success, since we aren't born to be traders. The process is against human nature, and trying to do the right thing in real time against the impulses is very difficult. It just seems that rewiring one's mind through these methods is necessary to even try applying all the planning, whether technical or psychological. What's your take on that, John?
So first off, I got to say that I love this question because this is definitely from somebody that has he's done some work to get to the place where he can even ask this question. So and he's thinking in a way that I like. He's trying to improve himself. Here's my advice on this. I You don't want to seek enlightenment, meaning you don't want to believe that you need to become some uber calm Zen master to trade the markets. That's not how you do it. What you need to seek is routine. Routine is how you can make winners and losers, and making a plan, seeing a trade, missing a trade, executing on a trade, all those things. Having a routine is how you can make all of those things normal and thus turn down the emotional volume, which you're correct in saying once you have an edge, it's all about that. So great job in seeing that. You ask about hypnotherapy or mental rehearsal. So there can be usefulness for something like mental rehearsal or visualization for trading. Most of the research, and there is research out there on that, most of it has to do with acquiring a mechanical skill, swinging a tennis racket, this or that. But you can use it for trading. And the way I would, first off, I'd have it in conjunction with meditation. So that's another answer that has to be a part of responding to this question is if you don't have a meditation practice, I would recommend you have one. And it non-denominational, doesn't have to have anything to do with any religion. It just can be any kind of meditative practice that teaches you to train your mind. And then using something like mental rehearsal. I'd refer you to a Huberman Lab episode. You can check that podcast for a lot more on this, but basically using something like 15-second rehearsals over and about 30 repetitions has been shown to help. I would recommend a trader could use these for something like the protocol that happens after a loss, or something of that nature, or what you do when a trade almost hits your target but doesn't. Like whatever time that you have the impulse to do something that is not in your plan, you could use rehearsals for. But I think stuff like that is to get through acute problems. Like I have a problem, I'm going to use this to attack it. I don't think that there's something that someone has to do every single day, although I think meditation is because I think it helps to align you with what's going on in your own body and mind, which is an important part of then figuring out what's going on in the market. But great question. Thanks, Victor, for that.
Right. All right, let's condense some of these answers if we can, because just out of the interest of time.
Mhm.
Um, so how possible is it to achieve 3R, meaning three risk factor, meaning three times gaining when we do gain three times the amount to be risked? How possible is it to achieve daily returns in line with 5R plus? How credible is it to generate 100R months day trading futures? 100R months, meaning 100 your risk, 100 times your risk on a monthly basis, day trading. How would
Mm.
you answer this?
So what he's really asking is it possible to be consistently profitable in the futures market? And is it possible to be consistently profitable at a rate of return that is more significant than investing in stocks? 3R, he's not clear on what is R. Is R your risk on a trade? Is R your limit for a day? So that part's not really clear. But what he's asking is it possible to be consistently successful in the futures market using leverage? And the answer is yes. I don't think we have to go much farther with this FT. Both you and I have a background in prop trading, and so we're aware of how the amount of money in your account is not really the deciding factor in how much you make. I'll put it this way though: is it possible to generate 100R based on your account in a month? Probably not no, not 100. But could you double your account in a month as a prop trader? I've seen plenty of guys have done it. So it's possible. That's the key to this guy's question is yes, it's possible. I've done it. I've seen it done. Same with FT. He's trained people to do it. So the answer is yes.
I believe so. Although, just keep risk in mind. The more you lever up to get those kinds of gains, the higher the risk, right? So just be careful with that. My trading style has a risk reward of 2 to 1, so 2R factor. Trading MNQ now, doing okay, nothing much better as I have a tendency to cut some of the winners short to avoid a loss, which results in less than 2 to 1. Often there are trades I exit with a 20-point winner only to see it go another 100 to 150 points. Other than drugs, which I love, like we jump right into drugs, how can I train, convince myself to hang on to some of those big winners? By Steve. What do you think? How would you tackle this?
Well, the first thing that this is a question I can't answer with just what's here, because if this guy was my trader and he's starting to have success with a 2 to 1 strategy, I'm not sure that I would mess with too much if he's starting to have success using a 2 to 1 risk reward ratio, because that's pretty good if you can consistently do it, especially in something like the MNQ where I mean, my assumption is he's probably like most of the guys that trade the MMQ. He's probably doing a lot of trades, scalpy. So if he's getting 2 to 1 and he's starting to see success, the first thing is, do we need to add a runner or really change that much? I don't know the answer to that. There's not enough here, but that would be the first question that I would tell him that he needs to reflect on. Do you need to do that? And then the next thing I would have to say is, if you're talking about going from a 20-point winner to 100-point winner, first off, I have a fear that maybe you're like there's like a bias towards the times that this has happened and less of a bias towards all the times where if you tried to capture 100 points it wouldn't have worked out. But that being said, I would start to add a runner or not and extend your targets. Like if you're normally going 1 to 2, then when you're able to add a contract or if you have enough contracts, I would start to try to get 1 at 3R. And if you're consistently getting that and you see that a lot of trades go further, then try to get 4R. But
Problem, sorry, John. The problem here, as far as I understand, maybe I'm wrong, maybe Steve's here. Um, The problem here is he's just not getting that 2 to 1. He's just cutting those off. You know, he's not allowing the trade. There's a tendency to just not allow the trade to go to its full target. That's what I'm understanding. You know, his plan is 2 to 1, but he's not getting it. So, you know, he's looking at how do I calm, you know, when you say drugs, I feel like what Steve's saying here is how do I calm my nerves enough to be able to just let the runners run or just to not act all the time. That's what I feel this question's asking. Is that not how you're reading it, John?
I read it a little bit differently, but I think similar, well, not so much similar applies, but if he's having trouble holding a trade to target, then he probably doesn't have like conviction in the system. Because if you have conviction in your system and your system says hold to 2R, then you're not looking at it as, oh, I want to get out of this early when it goes to 1R or when it goes to 1.5R. You're thinking that you want to use every bit of your stop to give your trade as much of a chance to be one of those ones that goes to target. Because if you trust the system and you've traded enough, you've seen all the trades that go to 1R, that go to 1.5, to whatever, and you learn that you have to hold out for the ones that go the distance, and you want to use as much of your room. It's not trying to get out as quickly. It's giving a trade as much of a chance to become one of those ones that wins because you can't figure it out before it happens. It just happens.
Yeah, for one, you need, I mean, instead of going and finding drugs to solve this, I think the first thing you need to do is go and keep a really good journal. Like what did actually happen? And if you keep good records, what's going to happen is you will have irrefutable proof, historical as it may be, irrefutable proof that you're more likely to get those targets than you are actually getting. And you'll start to see that, hey, my process works. But I agree with John here. You're not a believer in your plan if you have a plan. That's the main problem. You're micromanaging your trades, which is an error. What is that error costing you in terms of returns that you have missed? You need to figure out what that dollar value is, and that might change your mind. So I plan to do scale out of trades. How do you build a scaling out plan? This is from Anon.
This is one of those ones where like we really spend a lot of time on it in the program and like exactly this on how to scale out of trades, why we scale out of trades, how for some folks it may not be appropriate depending on your mindset. So this is really hard to just answer without knowing too much else about Anon, what his time frame is, what times of the day he trades, what product. It's very difficult. That being said, I guess if I had to give some just general ideas on scaling out, I would say that for me as a discretionary trader, the primary reason that I scale out is because once the risk is off in the trade, first off, it calms me mentally, which it is a factor. You have to plan for your mental game, and that's a factor that helps me in the trade. And second, it allows me to participate in more trades and get a better opportunity of catching an intraday trend. Those are the two reasons why I use scales. So you have to decide, or you have to decide what you want to trade, what your system's going to be. And then from that, if you're in the AP group, if you're in AP5, you're going to get plenty of this. If you're not, then, you know, you're going to have to figure it out on your own. What what type of trader you are and how your personality fits into scaling, how you want to use it. This is just really a tough one to give a better answer than that without knowing more about what this guy, what he's going to do in the markets.
Okay. Nicola, again, I have a problem. Love executing when market is open. I'm looking to see the open and set my limit orders based on the analysis from on previous day's profile. Is this a viable option?
I mean, you could certainly trade the daily bar if that's what you want to do. You just have to understand that if you used to trade the 30-minute chart and now you're trading the daily bar, then you're essentially going to get, what is it, 1/48th as many opportunities. So you won't get a trade every day. Uh, you know, you'll have long strings of very streaky strings of wins and losses, bigger swings. But can you do it? Certainly. You also may want to look at something like event contracts. That could also be something you'd want to trade. But is it a viable option? Certainly. Do I do it? I don't.
Okay. I've been stuck slightly above the break-even phase over the last 16 months. One of the biggest challenges I have is continuing to pull the trigger after a winning trade while pushing until daily loss limit on losing days. Man, if we could just charge a commission or a fee for every time this problem shows up,
Yeah.
we might have a sandwich. Also, this is where impulsive revenge trades happens most. Like, luckily, I've more winning trades than losing days to keep me alive. But how do I overcome this to get out of the break-even phase? John, this is kind of the usual recipe. Well, you want to go through
Yeah,
this recipe?
sure. So, Alan, from what you've said, I would say most likely you're in a feedback loop. And this feedback loop ends in two ways. It either ends with you getting one winner or it ends with complete disaster. And the reason that you're in this feedback loop is probably because you don't have a good system and you're not really well defined in what you do. So every day is just a flip of a coin. And some days you win that coin flip, and other days you just keep flipping the coin, but you don't have an edge to flipping that coin. So you're where you're at. How do you fix this? You need to, first off, you need to chunk the day better and sort of give yourself breaks. And then you need to see each trade as an individual event. And if you're not really doing that right now, which you probably aren't, well, you could have a mindset issue that's built up over time, or most likely you probably haven't defined your setups or trading conditions that well. That's generally what it is. Because once you get very specific about those things, you stop seeing trades as this big amalgamation of craziness that you go into, and they're discrete events that you judge yourself and your system by.
Yeah, this is a very typical problem, by the way. There's nothing unique here about what you're saying. Everybody kind of has to cross this bridge. Um, the best analogy I have for this is you've gone through a lot of effort to come up with the best minestrone soup recipe in the world. You've studied a lot of books, you've practiced, you've put it together. And then you've put it together into a plan. And you're going to make your minestrone soup to your most important guest. And it's showtime. And all of a sudden, you're like, ah, forget the salt. Forget measuring the salt. I'm just going to throw a handful in. And you know what? I've never thrown curry in my minestrone soup. And you know what? I've never thrown paprika in there. And I've never thrown, and you're just doing random things. You would be considered literally crazy in any other discipline but trading if you did that. Crazy. Why would you take a perfectly well worded and written and studied recipe and all of a sudden decide to just throw vegetables in there that don't belong in the recipe and changing the measurements of your ingredients and throwing different spices than what the plan says? You'd just be called crazy. But in trading, this is kind of a human response. It's a fight or flight response. It's a fight response is what you have here. So you have your plan has to get to the point where you're almost feel like you're doing something crazy if you go outside of what you need to see. And the only reason you would be impulsive or revenge trade or whatever is because you've got your P&L up on the screen or you have it calculated in your mind and now it's doing the driving. It's not the chef that's doing the driving. It's this other person. This is why I don't like it when a platform has the P&L shown on the screen, because the P&L is not relevant to my process. So you need to just sit and wait for the right ingredients to come together for you to take action. That's it. That's all. And so acting outside of that has to feel like a betrayal. It has to feel as uncomfortable as getting in the car and driving without the familiar feeling of a seatbelt across your chest. You kind of feel weird and naked, right? It needs to get to that part if you want to capture the feeling of it. Okay, Xavier is asking when markets fall and volatility fell and the volatility was extremely high, I found it difficult to gauge stop placement and entries. Even a 10-day harmonic was still not measuring stops wide enough for proper risk management. How did you trade during the high volatility versus now with extremely low volatility and low R vol after the recent contract roll?
Well, for me, my stops are generally on the tighter side. And I'll be honest with you, when the S&P initially just kind of, we had the big volatility expansion, it was such an expansion that it really, to me, the S&P kind of threw me out of sync. So I ended up spending a lot more time in crude. I just recognized that the S&P was more like a different product at that time. It was more like the Nasdaq is what I was kind of feeling it to be like, than the S&P that I'm familiar with. I have an interest rate background, so I kind of like, a little bit slower of a product. So I ended up really spending a lot more time in crude oil, which I thought which crude is a fantastic trade in my opinion. Especially if you trade indices and you want something else, like crude is fantastic. Gold's also pretty good, but I think crude kind of takes the cake in terms of being another product that offers opportunity every day. That and then when I am trading in the ES, my stop distance has pretty much doubled to tripled, which is really significant. I don't change my stops a lot. We get this question all the time, and it's pretty uncommon for me to say that I've doubled or tripled my stops, but that's about what it's taking right now. So, and it's overall, I think it is better as long as it doesn't get too algorithmic. But yeah, I've had to double or triple my stops.
I would say try to recognize when things are unusual. You get some pretty good clues when that happens. Um, when the market is, when for example, the opening swing is normally, 4 to 6 points, and all of a sudden we open and it's just going nuts and it's a 15 or 20 point opening swing. You can look at harmonic rotations, but that's an average. It's not an average. It's a distribution, but it's still a historical distribution. It's slow to respond. This is why we update it every week. But your eyes are much better immediate determinants of things changing. So it's really you need to recognize when it's not your game, you know. It's like getting in a fight. You're a fighter who's getting in a fight with people with your size, same weight class, and then you show up, and then suddenly heavyweights are in the ring, and there's a lot of them, and they're just punching the crap out of each other. You need to step out and let things calm down. On those days, by the way, I find that the better, cleaner trades occur later in the session. I do. I find that it finally, one of the things we teach in the accelerator programs to try to determine which um, which time frame player is in control based on a few things that we monitor, and usually day time frame or short time frame traders kick in after the IB's close is done, after the European close, and so on. So days where it's crazy in the morning at the open are generally pretty good if you just sit out that noise and just wait for the later session. What kind of order flow are you looking for? For example, if you want to short ES from 58 quarter to 5800, do you want to see heavy selling, balanced selling and buying? Do you want the move to be fast and explosive? This is from PT.
This is a tough one to kind of describe generally speaking, but some of the things that I'll look for if I'm looking for like a move from 58.25 down to 5800, I would be looking for price to extend rotations to the downside easily. I would want to see it look like the market is just rolling out the red carpet for lower prices, like it just rolls out very easily down and then kind of has a harder time retracing. I want to see that facilitating trade to the downside more. I also want to look for these extensions lower, specifically when we're hitting new prices. I want to see that drawing in more participation. I don't want to see these probes lower that are drying up. Like just it looks like a yo-yo that falls to the bottom and then snaps back up and it's gone. I want to see the market go lower, and I want to see more participants wanting to trade those prices. That is probably one of the biggest things that is sort of hard to describe in quote unquote order flow, but one of the more important is as we test new prices, are participants backing off of those new prices, or are participants clamoring to get involved in this new part of the range? Beyond that, I'll also look for more finished highs, less finished lows. Usually I'll look for one high that's pretty finished that I'm probably going to try to trade against. But those are kind of the general things that I would look for in something like this with a move, like looking for a move from 58 quarter to or 58.25 to 5800 even. Um, Things like that. There's a lot more to order flow that we could get into, but I probably this isn't the place to go down that rabbit hole to start talking, esoteric or
This,
footprint
yeah,
stuff.
that's its
Yeah.
own 8-part
Right.
series. Um, is the self-learning course released during the program starting April 18th the same as the one with the monthly subscription? If different, how it differs and what extra value it provides? There is no course in the monthly subscription. There is the Trade Right program, which is included as part of the community, and it's something you work through, and it's you can consider it a course, but it's kind of a quick way to get organized. But what we cover in the accelerator program is the accelerator course, but we attach coaching to that and we apply it during the execution lab week, and you get to watch that. So it is the same stuff. So if you cannot attend the accelerator program live, the best way to participate is to do the course and just kind of work through it yourself. Okay. And then we have these fireside chats that happen every month to answer questions, clarify some points, hear how people are doing, and so on. We've been hearing a lot of great feedback. If paying now for the accelerator program, can I postpone participation to next cohort time if it turns out, example, a week before the 18th that starting wouldn't be possible? Is my spot and price then secured without a rise in price? Christian, unfortunately, if you don't take that spot, and we have limited slots with every cohort because we cannot manage training a lot of people at the same time. If your spot can't be taken by you, we cannot sell that spot, and there's an opportunity cost to us in that somebody else got turned away because you were supposed to be there. So, make sure you can participate, and just be there. Just make the commitment and be there. Again, you don't have to be there live except for 2 hours a week for the first 4 weeks. That's live. The week of the execution, which will be May 19th week, you'll want to be there pretty much the whole day. We start at 8 Central, 9 Eastern, and we finish like at 2 p.m. Central or 3 Eastern, something like that. You want to be there for that. So the big commitment's that 1 week. Okay, just so you know. While trying to build my market pre-alignment, I have difficulty defining the last major swing. Could you tell me, for example, what the dates of the last major swing on the ES are, in your opinion? I was gonna do this. I was gonna send you the screen and so on. We only have 3 minutes left, so maybe you can tell us what it is.
Sure. I knew you wouldn't let me get a chart and a pen when we're pressed for time. Um, so the last major swing low in the ES, and when I if for anyone that's seen my prep, I'm always starting in the higher time frames. And for me, the last swing low, we made a low 55, 60, 61 half in the June contract. That was our low of 2 weeks ago. And for me, that's pretty much the last major finished low. Now we had been one time framing higher on the daily chart. Today we just snapped the one time framing today, made a lower low. So is that is yesterday? Is that a new major swing high? Is it, or is this the first pullback and we're retesting last week's high? We don't know. It's yet to be
What
seen.
was the
But
swing low
the
you
last major
mentioned?
swing lower is the low of 2 weeks ago,
50,
55 6.
5650, right? 75, or you seeing something else?
Uh,
Oh,
55.61 half on the ES. This is a
oh yeah.
RTH chart.
Okay, yeah. So this is the last swing low right here.
Yeah, the last major swing lower. It was a low of
And
2 weeks ago.
this is the swing high. We failed to retest and take it this morning, and it's just been selling from there. We took out the one-time framing up on the daily, so we ended that. So now it's repair time, and you have a nice big gap underneath here that we're in the middle of. So it's repair mode right now. So that's the swing we're looking at. You can also consider the 56, 50, 75 up, but that's just the intermediate swing or the shorter swing. That's valid as well. So it just depends on what time frame you're looking at. Okay. Dewey's asking, do you trade the market the entire day or just the first few hours of RTH? How long should a trading session be for a beginner? What makes the most sense to get an accurate feel for the market? This is our last question.
So when I trade isn't really that applicable. I'll put it this way. When I was in a prop shop, I was there for 12 hours a day. It was a different time. I was in my 20s. Nowadays, most of my trading does generally happen between about 9:30 Eastern and 11:30 Eastern, with often a fair amount of trading coming between about earlier than that, about 6 a.m. to 8:30 a.m. Eastern. But for a learning trader, so I think that there's a lot of good information out there now about deep work and how long bouts of work should be. If Cal Newport wrote a book on it. His rule was 4 hours, and there was a lot of work done by a guy named Anders Ericsson about flow that also kind of you thought that 4 hours was a pretty good time frame for deep, intense cognitive load. And what Erickson kind of looked at was those 2 hour or that 4 hour period should have a break in the middle. There's a lot of research out there also about a 90-minute window. So I think really for someone newer, I would not go longer than about 90 minutes without taking a 10 or a 15-minute break. And if you wanted to do two 90-minute sessions, like trade 90 minutes, break 90 more minutes, this would be trading from like the cash open into the euro close. That's certainly within the capabilities of most people. However, I would really, really urge you to err on the side of giving more time to review and prep when you're newer. I would also say that I think that a lot of people are just not familiar with kind of how cognitively difficult, like the cognitive load that is on you if you're actually watching the market, stalking for setups. And it gets easier as you've done it for longer. You can become more used to kind of sitting back, anchoring your attention to the market, and then coming in and getting super intense when you're stalking. But for someone that's newer, I think that just the learning how to handle that cognitive load is going to be difficult. And I would say keep it to 90 minutes at the most before you take a 10 or a 15-minute break. And just based on the research that's out there, as a beginner, I wouldn't go longer than maybe 4 hours in a single day. That's giving you a lot of time to review. Obviously, individuals have different schedules. It varies, but those are fairly general guidelines.
Yeah, that's excellent. You know, you there's only so much you can glean by staring at the screen all day, and a lot of people advocate for that. I don't think that's the right answer. I really would rather see you, Earl, our trader, who's trying to make it through the trainee trader program. I would rather see Earl define his process like he's done, and then execute the process within the parameters of the plan, and then just move on through the doldrums. I would rather make sure that there's a lot of time spent annotating charts, looking at the market, defining things, seeing how things repeat themselves, the nature of the market, and so on. That's really what you want to do with your time if you're not executing. And then what's really important is taking away and doing that question. I think it was Alan who asked about cutting winners short, like spending a lot of time studying. Okay, I took these trades, let me plop them on a chart. What actually happened? What would have happened to this trade had I held on to it? Or is my stop getting triggered at the very bottom of a move? Or that sort of stuff is really much more juicy in terms of getting something out of your effort tomorrow. Your prep, just studying the market from outside in, that sort of stuff, from a bigger time frame down. It's much more valuable than staring at the screen at ticks kind of forming. That's what I feel is more important. We're out of time. It's 4:19 my time. We're 4 minutes over. Thank you all for being here. I just want to remind you all that the next event, let me see where that slide is. There it is. The next event is on April 23rd. April 23rd. And a final reminder that the accelerator program has a limited number of participants. It starts on April 18th. And the signups are open now. So go to ct.pro/accelerator 2025. If not, then we'll catch you at the next AMA. Thank you so much, John, for answering all those questions, and JC for keeping an eye on things for us. Thank you all for being here. Take care. We'll catch you next time. Cheers.
Cheers, everyone.
Cheers. Thank you.